Hello, everyone. Thank you for joining today's Prime Money Moves webinar series. My name is Joshua Zeb. I'll be your host. For those who are new, welcome. For those who are frequent viewers of our webinar series, welcome back. Today, I am hosting the webinar. I have my colleague from the Success Hub, Sophie Slomkowski, with us that will be helping discuss our topic at hand, which I think both of us are very passionate about, and that would be understanding the differences between Roth and pre-tax. For those who are not familiar with our platform, you can ask questions, of course, and we're more than happy to answer during the webinar or afterwards. And feel free, of course, to ask any questions kind of during the presentation today. But like I mentioned before, we're going to be discussing Roth and pre-tax. And this really comes down to more of a savings perspective, right? Is we all want to save for retirement or from some big goal we might have. But the more money we save, ideally, we have less stress. Ideally, we can feel a little bit more confident about retiring and, maybe taking some advantages when it comes to taxes and maybe ways that we can put ourselves in a great situation going forward. Ideally, all of us have some savings, maybe through our company retirement plans. Ideally, there's a match too with that. But what we wanted to do today is kind of describe why pre-tax and Roth are both beneficial. There's huge benefits to both. And we just kind of want to make sure everybody kind of knows the differences between the two and really how people can take advantage of both of them. We're going to start off with kind of just an explanation of the pre-tax contributions. So if you guys are currently contributing inside of your retirement plan, you might have heard the word traditional or traditional contributions. That's another way of saying pre-tax contributions. Again, the idea behind it is you're going to be putting money away pre-tax, or you have not paid taxes on your savings that will be going into your account. It's going to grow tax deferred, and you'll be paying taxes on your contributions and growth whenever you withdraw the money at retirement. There's obviously some benefits to that when it comes to your tax situation for the current year. A good example is what we have right below, which is someone that's receiving $80,000 of compensation. If they contribute 10% of their compensation, which is $8,000, into this pre-tax bucket, when they file for their taxes or their W-2, you're going to see that they only earned $72,000, not $80,000, right? Because you were contributing $8,000 pre-tax into that specific bucket. So again, it does help with some current tax situations that you might have. Obviously, it could be a huge, huge benefit for some of you. On the other hand, there is the Roth option. It's relatively the newer option of the two. It's only been around for about 20 to 30 years. And we see a lot more people maybe interested in Roth or maybe wanting to understand what Roth contributions are. Another way of putting or phrasing Roth contributions is after tax. You're going to contribute money that is post-tax into a specific account. Ideally, you paid the taxes up front, right? It's going to grow over time. And when you withdraw this money at retirement, well, you already paid taxes on it, so you don't pay taxes on the back end, as long as it's a qualified distribution. Now, what's really important here is the example of this $80,000 individual. If they put in that 10% or $8,000 into a after-tax Roth account, they don't get the tax advantage like the pre-tax individual did. So the benefit of the Roth account will be on the back side whenever you withdraw the money, ideally tax-free. So again, that's kind of a good way to kind of think about the two. Again, pre-tax, you're going to be delaying the taxes until retirement or withdrawing for retirement. Roth, you're going to be paying the taxes up front. We wanted to give you a paycheck example here of how this could maybe impact maybe day-to-day living. I'm a huge advocate for people whenever they are saving inside an employer-sponsored account or plan, look at your paycheck. See actually what the dollar amount is that's going into your retirement account. and how is it affecting your take-home pay. So what we have here is an example of a pre-tax contribution and a Roth contribution. These individuals have the same wage of $1,200. They're both going to contribute 10%, so $120. But the difference here is going to be how much is subject to income tax. The pre-tax amount, you can see here, it's a little bit lower than if someone were to do the Roth, right? You can see that it's only $1,800 or $1,080. That's going to be subject to income tax, whereas the Roth portion is going to be that full $1,200. So again, that does change the tax situation of your current paycheck, right? And with that being said, you can see how much taxes are paid. With the pre-tax portion, it's going to be a little bit lower of how much taxes you owed compared to the Roth, which was the 198. The Social Security, the Medicare are the same, but the net pay is a little bit different because of it. So again, pre-tax, we can see here, you get a little bit more take-home pay compared to the after-tax if you were going to do an after-tax contribution inside of your account. Again, the take-home pay will vary depending on if you're doing one or the other. And I think that's pretty important for people who are maybe living paycheck to paycheck. Again, I'm a huge advocate for people to look at what their pay stub is to maybe see where the chips lie when it comes to the actual dollar. Now, with that being said, I wanted to just kind of describe the two, but when myself or if Sophie's in the field and we're talking to quite a bit of employees and participants around the country, one of the questions you always get is, okay, I understand what pre-tax and Roth is, but what should I do? What's the right method for me? So, Sophie, I wanted you to maybe describe, what pre-tax mindset people look like, and maybe people who are more looking for the Roth, and what is beneficial to both. So could you just maybe go into the mindset of someone doing pre-tax compared to Roth?
Yeah, certainly. This really is the golden question, I think, here, and probably the reason most of you have joined today. This is a topic we are very passionate about. Not only do we see it very frequently out doing education, but also in our day-to-day lives. Funny enough, I was having dinner with some friends the other weekend and explaining what we do in the retirement plan industry. And this was the number one question: Sophie, do I do Roth or do I do pre-tax? So now that we've learned a little bit about both, I'm going to go over a few scenarios, and I want you to really listen and think about what applies to your situation, and hopefully that'll give you a better idea of what might be best for you. So with that being said, the pre-tax mindset, you might want to have this tax deduction during your current year. If you are in a higher tax bracket, that might be very vital to you. If you are someone who is living paycheck to paycheck, thinking back to Josh's paycheck examples, every dollar is critical. You might not be able to give up that $20 in Roth at this time. So pre-tax is going to be a great scenario there. If you believe that where you are now, you are going to be paying taxes at the highest point versus when you are in retirement making withdrawals, pre-tax is going to be a great strategy there. So let's switch gears into the Roth mindset. This is going to be someone who's in a lower tax bracket. And we do see this a lot with individuals who are maybe early on in their career. We do see as they go throughout their career, salaries might get higher, which is great, but that also means a higher tax bracket. You might know what your taxes are right now, but the future is unknown. And we can't tell you what's going to happen in 20, 30, 50 years. Usually taxes are increasing, so it might be best to pay them ahead of time and get that done. You might want to have the ability to have a savings bucket with no tax implications. So, retirement looks different for everybody. You may want to have an emergency savings. You may want to take a lot of vacations. Or you may just want to be prepared for any unexpected expenses, healthcare costs. So you don't want to have to worry about an increase of taxes at that time, and Roth might be better for right now and get that done with. Maybe you want to diversify your savings. So if you are contributing pre-tax right now, and let's say your employer match is also going in pre-tax, well, you might not be getting much diversity there. So changing your contribution to Roth might really help diversify that. And then last but certainly not least, I think a huge benefit to Roth is avoiding the required minimum distributions, which, RMDs is basically the IRS. They want their taxes paid. So they are going to have an annual mandatory distribution of your retirement. And using Roth, we can avoid that completely.
No, very good points. I totally agree with you there. I mean, there's so many benefits, I think, to both. And, at the end of the day, I think, I speak for myself here. We all want to try and, put ourselves in a good tax situation. So, there's not necessarily a one size fits all approach, but if you think you're saving more money on taxes doing the pre-tax or Roth, obviously that is something that's more personal to you. And regarding the more Roth mindset, I'm from Kansas, so I love to use farm analogies. We have this analogy for like pre-tax versus Roth, which is the seed or the harvest. And generally what that means is, would you rather pay taxes on a seed if you're a farmer, or the harvest of your crop, right? So the seed being more of the after-tax Roth approach, the harvest being more of the pre-tax approach. So I always thought that was kind of interesting from a farming perspective. A couple other things to consider. Sophie mentioned it, but splitting up your deferrals can also be pretty powerful. So if you do have a Roth 401k option in part of your retirement plan, maybe that's something you could be interested in starting, or at least maybe splitting up your deferrals for. And that kind of goes into the next point is, when Sophie and I are in the field, a lot of times we do talk about pre-tax and Roth. And the question we get a lot, or the statement we get a lot is, when we hear Roth, a lot of people think of Roth IRA immediately. And people might not understand that there's actually maybe a Roth 401k option, and they're actually two completely different accounts. Again, Roth 401k and Roth IRA. Roth 401k is part of your maybe employer plan. Roth IRA is something you do individually. So that could be an option if you guys aren't sure. Maybe look on your record keeper website and see if that's an option. And then with that, the Roth 401k contribution amounts are actually significantly higher than a Roth IRA. So they do have the same standard as the traditional bucket inside of a 401k account. Think about it as kind of the same bucket of money when it comes to your maximum savings amount you could do in there. And with that being said too, with Roth IRAs, they do have what is considered an income limit or limitation. So if you earn a certain amount of money and up, you cannot contribute to a Roth IRA. With Roth 401k, there is no income restriction at all. So if people who are maybe a high income earner above that threshold, then maybe a Roth 401k might be something that you're interested in doing if you want to have some after-tax savings. The last bullet point you might see on the screen, it says, historically, any employer contributions must be made pre-tax. Again, you may have heard some changes of that in the near future. Again, you'll be first to know if that's going to be part of your plan, if they have a Roth employer match option or not. I'm not going to spend too much time on that, but Sophie mentioned this before. If people are contributing inside their retirement accounts and have an employer match, well, if they do the Roth contribution option for themselves, they will still receive the employer match, but it will be with pre-tax dollars. So technically, if you're doing a Roth contribution in your 401k or your qualified retirement account, if you have a match, you're kind of doing both buckets of having some pre-tax and some after-tax savings. So again, tax diversification is very important. For those who are working with an advisor or planner, I'm sure they will tell you that all the time. And it can be a huge benefit for people who are planning for retirement. And I wanted to show you this slide here of how maybe impactful that could be for people who are maybe close to retirement. We have two different approaches to maybe withdrawing money in retirement or at retirement. We have the single bucket approach, and then we have a three bucket approach. Now, of course, it's a case-by-case situation, but just for the example here, we're going to say we need $100,000 that we're going to withdraw in retirement. The single bucket approach, maybe this person only had a pre-tax bucket available, so they're going to withdraw $100,000 in this year. Well, remember, we're deferring the taxes until retirement, so we need to pay taxes on our withdrawals. And that'll be according to your ordinary income, or essentially how much money do you withdraw during that year. So with $100,000 of a withdrawal, the IRS is going to consider that as, hey, you earned $100,000, we're going to tax you as such. So we're going to put you in the 22% tax bracket, because that's for what it is for $100,000. So we're going to pay $22,000 in taxes for the year, and a net amount of $78,000. The three bucket approach is, if we have different ways we have saved over the years, perhaps we have a pre-tax bucket, a Roth bucket, and maybe a taxable brokerage account that we might have. Well, maybe we take a little bit out of everything to manipulate our tax situation. So again, we're going to still withdraw $100,000, but we're going to do it in a little different way. With the pre-tax, we're going to withdraw $60,000. We still have to pay taxes on that. So the tax bracket for $60,000 is going to be 12%. So we're going to have a net amount of $52,800. We go to our Roth bucket. We're going to withdraw $25,000 from that. Well, we already paid taxes at the very beginning on that account, so we're not going to be paying taxes when we withdraw it. So that's a huge benefit here of, okay, if we want to withdraw $25,000, we're going to get that net amount of $25,000. And then our last bucket is going to be that brokerage account. So let's just say we withdraw $15,000 from that. We're going to pay capital gains tax on this. So we're going to have a net amount of $12,750. So these three net amounts combined to be that $91,300. Now you compare that to, of course, the single bucket approach. Again, you can see the significant difference in how much you have maybe in your checking account or for the year for income. Now, that's not to say that the single bucket approach is bad or anything like that. It's just trying to more illustrate of, hey, maybe some tax diversification would be very powerful for me, especially when it comes to maybe having some emergency expenses or things that maybe you didn't expect. All right. A couple other things to think about when it comes to the Roth deferrals for people who are maybe interested is, as I mentioned on the last slide, is going to be the tax diversification. Number two is going to be predictability. And when I say predictability, I mean when I need a certain amount to withdraw. Good example is, if you tear up two tires on your car or need a new radiator, a new heater in your house, those things aren't cheap. So we can just withdraw a certain amount and not have to worry about the tax situation behind it. And then thirdly, Sophie mentioned this of the future being unknown. So again, the idea with Roth is getting the tax liability out of the way so you don't have to worry about it down the road. And that's something, obviously, with the future unknown is we don't know what taxes might be 10, 15, 20 years down the road. So those are three things to really think about when it comes to the Roth side. Now, I wanted to pivot a little bit and ask Sophie a couple of questions here. I mean, we have so many changes in the retirement plan space. Some of you might have heard of Secure 2.0. So, Sophie, I know you wanted to maybe mention a couple things regarding Secure 2.0 that might be really important. So, what did you want to share?
Yeah, hopefully everybody's awake. I know this slide can be a little boring sometimes, but you don't have to remember it all. That's okay. That's what we're here for too. But to start off with some of the recent changes, beginning Jan 1 of the year of 26, there was a significant change under the Secure 2.0 Act, and this is going to affect our high income earners age 50 and up. So if you earned more than 150,000 in FICA wages in the year of 2025, any catch-up contributions you make in 2026 must be made on a Roth basis. The impact of this, these individuals can no longer make pre-tax catch-up contributions. This also can result in a higher current tax year bill and lower take-home pay. And again, this is going to affect more our high income earners age 50 and older. And the limits that they impose here, so the catch-up limit is now 8,000 for those 50 and up, or for super catch-up, which is ages 60 to 63, that limit is going to be 11,250.
No, I think these are very important changes that could affect maybe some of you on here. So I'm sure you've gotten some notifications on this with your record keeper, but again, for those who are maybe the higher income earners or maybe in that catch-up contribution category, there are some changes to be aware of. So always be cognizant of that. We always want to make sure people are prepared for that. We are kind of narrowing down the end of the presentation. So we want to kind of go through a couple key takeaways, of course, of the pre-tax and Roth side. Of course, with the after-tax basis of Roth, you don't pay taxes on withdrawals, including earnings during retirement, as long as it's a qualified distribution. A couple other things is the predictability and tax diversification aspect of Roth. So that can be pretty powerful. And then you can see on the third checklist here, it says to qualify for tax-free distributions, you should be at least 59 and a half, deceased, disabled, or your first designated Roth contribution must be made at least 5 years earlier than the date of distribution. This is a very important part when it comes to people maybe closer to retirement that think that Roth might be good for them. Again, to have a qualified tax-free distribution, your first designated Roth contribution must be made at least 5 years earlier than that. So, for example, if I'm maybe about to retire, I'm age 60, and I start contributing in my Roth account in 2022, I have to wait until 2027. That's 5 years until I can have that qualified tax-free distribution for my Roth account. That only is for the Roth savings amount. So again, just make sure that you know when your first designated Roth contribution is. As a reminder, there is a Roth 401k contribution limit, which is going to be $24,500 if you're under the age of 50. If you're over the age of 50, that's going to be that additional $8,000. And you did see that catch-up amount of the additional $11,250 that you can put in here. Again, very important for those who are maybe interested into contributing to a Roth is going to be the Roth 401k has no income limits, as I mentioned beforehand. So it could be a great way to put away some money after tax. We wanted to go through a couple other savings vehicles. We've talked about, more of the retirement plan side through your employers, but there are also other ways to save money. That would include the IRA, Roth IRA. IRA stands for Individual Retirement Account. Again, you can open these at any financial institution, or if you work with an advisor, they'd be more than happy to set something up with you. There are what are called health savings account. If you are part of a high deductible health plan, HSA might be a way to put away some savings just for medical expenses. There's some benefits to that. And then more on the education side, there are what are called 529 plans. And this is a way to maybe contribute some dollars for maybe a child you have, or maybe a grandchild you have, to maybe help out when it comes to those big expenses. As we probably all know, those college expenses are just going up and up. So again, these are other savings vehicles that you might consider outside of the company retirement plan. So I always like getting kind of like next steps for everybody on here of maybe what we can do maybe today or next week. Is number one is log into your retirement accounts if you have any, and just see what your current savings rate is. Just, out of curiosity, what are you contributing inside the plan? I mean, I mentioned it a couple times. Look at your paycheck, see what the dollar amount is behind that. Maybe you can go up 1 or 2%, which is step two, which is make sure you're at least getting to the employer match if you have one, and maybe bump it up a little bit from there. 1 or 2% doesn't sound like a lot, but over time it can add up quite a bit. And maybe you can diversify how you save. Maybe you put any additional percentage points into that Roth bucket I mentioned beforehand, which is step three, which is increasing Roth contributions, or at least maybe starting the bucket for that. I think it's a great way, thinking about it from that predictability standpoint of having some extra dollars that, hey, this is going to be my emergency savings bucket in retirement. I'm going to withdraw from it when I need it, not necessarily all the time, but there are advantages to maybe doing that 3-bucket approach of maybe making withdrawals continuously to maybe manipulate your tax situation. And of course, fourth and final is diversify your savings. If you have a retirement plan, take advantage of that. If you want to save outside of that with an IRA or maybe an HSA, if that's available, or maybe even like a 529 plan that you want to open up for a child. There's a lot of different ways to put away money for the future. And with that, I know we have our great Success Hub team made up with Sophie and Avery that are more than happy to help. So Sophie, could you maybe elaborate a little bit more on what you can do with people that are logged in today?
Yeah, of course. So, we cover a lot in these webinars, but if you want us to take a look, maybe more about your specific situation, this is something you could schedule a one-on-one meeting with the Success Hub for. Let's say you have a rollover, or you just need help enrolling in your plan, or just want a financial check-in. Feel free to meet with us. We are a resource here for you, and we'd love to talk to you. So in the bottom right corner, there is a QR code you can scan, or feel free to reach out to us directly in our emails as well.
Perfect. Thanks, Sophie, so much. Just as a reminder, we do have these webinars once a month. And next month, you can see here, it's going to be on March 25th, going over healthcare cost coverage and what retirees should know. I think that's very important as people lead into retirement, is that's a major expense people maybe might be interested in thinking about. April, we're going to go over estate planning, and then May, we're going to be going over student loans and maybe ways to combat that. So with that being said, we're going to go ahead and conclude the presentation today. For those who did type in questions, we are going to submit our questions to you after our webinar today, so just be on the lookout for your email. But we appreciate everyone that did ask a question in here. We'll make sure to get back to you. Sophie, thank you so much for joining me today. Thank you everyone for joining live, and I hope everyone has a great day. I hope you got a couple good snippets out of today's presentation, and we look forward to seeing you next time. Take care.